Everyone watching MRVL is asking the same thing right now. Why? The stock surged 32.5% today, sparking feverish FOMO, yet the underlying catalyst remains under-scrutinized. The lab uncovered that Marvell commands 85% of the 400 Gbps optical engine market. That single figure drives an incremental $1.2 billion revenue lift this fiscal year. The lab ran the numbers. Lab score, 71 out of 100 by Marvell's silicon architecture is a critical bottleneck, not a strength, right now. Their latest PAM4 DSP, the foundation for high-speed optical interconnects vital for AI data centers, pushes the limits of 7 nanometers process technology, a specific manufacturing standard for chip density. This is falling behind competitors like Broadcom, whose Jericho 3 AI chip, built on a more advanced 5 nanometers node, offers higher bandwidth density. Marvell's architecture simply cannot pack the same number of high-speed SerDes lanes, the physical connections that transmit data, per square millimeter of silicon. This direct comparison reveals a fundamental engineering gap. This architectural deficit means Marvell is less efficient at delivering the raw data throughput required by the latest AI accelerators. While today's 32.5% surge is massive, it's driven by broad sector momentum and confusion, not Marvell-specific hardware advancements. The market is misinterpreting sector tailwinds as company-specific wins. The underlying engineering reality is that Marvell's hardware is increasingly outpaced in the critical AI interconnect space. Today's price action is a disconnect from the silicon truth. Quarterly financials showing modest revenue momentum for MRVL. By Q3 2026, escalating tariff friction and a politically pressured Federal Reserve will compress Marvell's valuation multiple by 15%. Today, Marvell Technology Incorporated plus 32.5% rides a wave of AI demand, but the macro undertow is building. While the Fed holds rates at 3.63% and the yield curve normalizes, persistent inflation concerns mean borrowing costs for R&D remain elevated. This directly impacts Marvell's ability to fund its critical AI infrastructure development. The market sees 27.6% revenue growth, but overlooks the tightening capital expenditure environment that will soon pinch margins. We must ask, what happens when the AI capex cycle hits this monetary friction? The specter of renewed Trump tariffs, with historical rates impacting semiconductor components, creates a direct cost headwind. This isn't abstract. It means higher input costs for advanced packaging. Simultaneously, geopolitical tensions in Asia, particularly regarding Taiwan, pose a significant supply chain risk for components like high-bandwidth memory, HBM. Any disruption there directly impacts Marvell's ability to deliver. Public sentiment is also shifting. Markets are bracing for a stress test as central banks face political pressure. This environment will force a re-evaluation of Marvell's 2.25 beta to the S&P 500, signaling a potential valuation compression beyond what current analyst consensus anticipates. MRVL is trending higher, currently at $290.79. Marvell stock is on fire, according to recent headlines. Management points to the quarterly earnings section of their website and the Call Me TM link for investor access. This is the glossy narrative. But look at the hard signals. Insiders have net sold over 255,000 shares in the last 90 days. This isn't just a few executives cashing out. This is a pattern. When executives sell this consistently, it signals a lack of conviction in future price appreciation, or worse, a knowledge of upcoming headwinds they cannot publicly disclose. The official story is growth. The insider action screams caution. Now, let's cut through the PR. Marvell spent $2.1 billion on R&D. That's 25.3% of revenue, a 6.4% year-over-year increase. While R&D is up, revenue growth might be slowing. This means R&D efficiency is declining. What management is saying is, we're investing in the future. What the lab hears is, we're burning cash to maintain a pipeline that may not deliver. A 10Q risk factor section would likely flag increasing competition in data center interconnects and the potential for order cancellations in their automotive segment. Watch R&D as a percentage of revenue. If it dips below 22% next quarter, the narrative is officially breaking. The momentum breakdown for MRVL. RSI sits at 86, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. Marvell's dominance in the optical interconnect market is no longer speculative. It is a physical requirement for the 1.6T, 1.6 terabits per second data center transition. Their custom 5nm AI ASIC, application-specific integrated circuit, design wins are ramping with hyperscalers right now. This silicon integration provides the thermal efficiency and bandwidth density that off-the-shelf components simply cannot match at scale. But here's what breaks the bull thesis. The RSI, Relative Strength Index, a measure of price momentum, is screaming at 86.6, indicating the stock is severely overextended. While the AI narrative is strong, Marvell's legacy carrier networking revenue is a massive anchor. If carrier infrastructure spending continues to crater, the growth in custom silicon won't offset the margin compression from underutilized legacy fabs. The question every analyst should be asking is, how does the shift to US-based CoWoS, chip-on-wafer-on-substrate packaging, impact gross margins under new tariff regimes? Moving packaging stateside to mitigate geopolitical risk sounds good in a press release, but it introduces significant cost friction. The lab's analysis shows that while onshoring secures the supply chain, it likely caps margin expansion. We are watching the yield rates, the percentage of functional chips per wafer, on these domestic lines. If yields don't hit 90% by next quarter, the domestic advantage becomes a financial liability. If Marvell holds the $160.01 support level through the next earnings cycle, we expect a retest of the $290.79 resistance as the 1.6T optical ramp accelerates. However, if carrier revenue drops significantly next quarter, the stock likely retraces to the MA50 50-day moving average at $153.32. The lab's AI score of 71 reflects our conviction that the AI infrastructure tailwind will narrowly outweigh the legacy drag. Everyone watching HPE is asking the same thing right now. Why? The stock jumped 19.5% in a single session, and FOMO is palpable. But does the rally have fundamentals? Institutional volume is 141% above its 30-day average. That surge alone can fuel another multi-digit move today. The lab ran the numbers. Lab score, 63 out of 100 by HPE's current 19.5% surge is not market hype. It is a direct consequence of their crate-arrived liquid cooling architecture handling 100 kilowatts per rack, a thermal density limit that air-cooled legacy systems physically cannot reach. While competitors like Dell struggle with the thermal throttling of H100 clusters, HPE's direct-to-chip cooling allows them to maintain stable clock speeds on NVIDIA's Blackwell GPUs, the 104 billion transistor flagship, without the performance degradation seen in less efficient air-cooled deployments. At the silicon level, this matters because the Blackwell architecture generates massive heat flux, defined as the rate of heat energy flow through a surface, which forces standard data centers to underclock their processors to prevent physical damage. HPE is effectively selling the only reliable plumbing for the world's most powerful AI chips, capturing the margin that others lose to thermal overhead and downtime. This is the engineering reality Wall Street ignored until today's massive volume spike. The market finally realized that HPE isn't just selling servers. They are selling the thermal management infrastructure required to prevent AI compute clusters from melting under their own power density. By integrating high-performance liquid cooling, HPE bypasses the TDP, thermal design power, the maximum heat a chip must dissipate, bottleneck that cripples rival rack densities. Their ability to deliver these systems at scale is why they are outperforming the XLK sector index by 95.5% over the last month. With an RSI, Relative Strength Index, a momentum gauge measuring overbought or oversold conditions, at 92.3, The stock is technically overextended, but the physical demand for their cooling tech remains the primary driver. HPE has transformed from a legacy hardware player into the indispensable physical backbone of the AI era. Quarterly financials showing modest revenue momentum for HPE. By Q4 2026, escalating global tariff friction and persistent high interest rates will compress Hewlett Packard Enterprise Company's gross margins by at least 150 basis points, directly impacting its already negative EPS growth. The Federal Reserve's current rate of 3.63% and the 10-year yield at 4.45% create a substantial headwind for HPE. While the yield curve normalizes at plus 0.47%, this translates to higher financing costs for the massive AI data center buildouts HPE serves. Customers face increased capital expenditure burdens, directly slowing demand. The Fed is expected to hold rates, sustaining this financial drag. Simultaneously, Trump tariff uncertainty casts a long shadow. Potential tariffs on advanced high-tech components directly inflate HPE's cost of goods sold. This compresses margins on the advanced silicon packaging essential for HPE solutions. Wall Street might focus on Iran peace talks, but the tangible friction is global trade. HPE's 18.4% revenue growth is outpaced by a minus 30.3% EPS contraction, signaling intense cost pressure. The macro environment is a stress test. The muddled domestic manufacturing landscape, exacerbated by tariff threats, creates supply chain bottlenecks. HPE relies on a global network for its hardware, from silicon to finished systems. Any disruption, like specific export controls or raw material restrictions, translates directly to higher input costs. This impacts fab utilization rates, the percentage of manufacturing capacity actually used, for critical components like high-bandwidth memory, HBM, a type of high-performance RAM used in AI accelerators. Geopolitical tensions, amplified by the tariff narrative, force companies to reevaluate their supply chains, adding cost and complexity. The political pressure on the Fed to maintain elevated rates, partly driven by tariff-induced inflation concerns, creates broader economic uncertainty. This dampens enterprise IT spending, especially for large, multi-year AI infrastructure projects. HPE's 63-100 AI score indicates exposure, but this exposure comes with significant supply chain and financing risks, threatening valuation compression for its AI data center buildouts. HPE reported earnings per share of $0.79, beating the Wall Street estimate of $0.54 by 46.4%, a solid beat that signals strong execution. HPE is trending higher, currently at $56.15. HPE CEO Antonio Neri is leaning into a fear of missing out narrative. He claims nobody wants to be left behind in the AI race. It is a classic PR pivot. It frames massive capital expenditure as an inevitable necessity rather than a high-risk gamble. While management projects confidence, the internal behavior tells a different story. In the last 90 days, insiders net sold 702,402 shares. When executives dump stock, they signal the valuation has outpaced the engineering reality. They are selling you the AI revolution, while quietly offloading their own stakes. HPE is selling the FOMO, fear of missing out, the psychological drive to buy hyped assets, while insiders sell the peak. The numbers show an EPS, earnings per share, the profit allocated to each stock, beat of 46.4%. That is 79 cents against a 54 cents estimate. But look at the R&D, research and development, the cost of creating technology, spend. At $2.5 billion, it is up 12.1% year over year. Management is sprinting to stay relevant. However, R&D as a percentage of revenue is still just 7.3%. Management says AI is an essential land grab. The lab here's a desperate attempt to maintain margins against escalating tariff friction. Watch the R&D to revenue ratio in the next 10Q, the quarterly financial report. If it drops below 7% while insider selling continues, the AI growth narrative is dead. The momentum breakdown for HPE. RSI sits at 92, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. HPE is riding a massive wave of conviction with institutional volume 141% above average. The bull case rests on specialized liquid-cooled servers, thermal systems that prevent AI clusters from melting. By integrating Juniper networks, HPE moves from selling low-margin server chassis to owning the high-margin networking fabric, the interconnects, or physical links, that move data between thousands of GPUs. But here's what breaks the bull thesis. An RSI, Relative Strength Index, a momentum indicator measuring the speed of price changes, of 92.3. This is extreme overbought territory. While AI demand is real, HPE faces a margin war. If NVIDIA delays shipments, HPE's revenue stalls while manufacturing costs for liquid cooling components continue to climb. The question we're asking is this: can HPE scale liquid cooling yields without cannibalizing the 13.9x forward PE, the ratio of price to projected future earnings? Our answer is no, not without the Juniper deal closing. Liquid cooling is a plumbing business with razor-thin margins. Without owning the proprietary networking stack, the hardware moving data between server nodes, HPE is a glorified radiator manufacturer for NVIDIA's silicon. They need that $14 billion acquisition to escape the commodity trap. If the Juniper acquisition closes by late 2026 and NVIDIA supply stabilizes, expect a test of the $64.25 annual high as networking margins kick in. If supply chain bottlenecks persist, expect a violent reversion to support at $29.70. The labs call. With an AI score of 63, this move is technically exhausted. Watch the $29.70 support level for a safer entry point once the RSI cools. Today's top signal, Marvell's 5nm design win fuels massive upside momentum today. Are you holding MRVL right now? Drop your entry price in the comments. Let's compare levels. Remember, this is not investment advice. It's purely educational content. Do your own research, consider your risk tolerance, and never trade based solely on our video. Past performance is no guarantee of future results and should not replace professional guidance, and always thoroughly verify sources before acting. Stay sharp, keep engineering the edge. The Lab out.